Groupon. Another new low for the internet coupon company this morning, as yesterday they reported earnings and revenue came in a lot lighter than expected. George Stahl from Dow Jones joins us now. George, the top line, $568 million. It was supposed to be 580 to 620. They came in really light. But that was despite the fact that they have this one product that actually inflates the revenue line.
Exactly, but comes at the price of margins because it's a much lower margin product. And overall, it was a very discouraging earnings report from Groupon, where there were far more negative indicators than there were positive indicators for the company. I mean, this is a company that came to public because of its daily deals business. That business seems to be slowing. The subscriber interest seems to be waning, and it's never taken off in Europe, and they're trying to fix that. Meanwhile, as you said, they're trying to expand into other businesses like Groupon Payments and other services to tap that local business market.
But it's going to take a while for those things to catch up. While the core business, because this is interesting, this thing they call Groupon Goods, which is now 26% of their revenue, up from 3% just 2 quarters ago. They effectively sell products instead of deals for restaurants and spas, but they're the ones that they take those goods into inventory. And in other words, when they sell them, they recognize the whole cost of the deal as their revenue. Whereas with the other deals, they only recognize their portion of the split. The spa, the restaurant gets their portion, and Groupon only recognizes their net revenue. So as that portion of revenue grows from 3% to 26%, that's that is blown up. I mean, it's really inflating margins, but it's blown up cost of goods sold.
Exactly. And I read that in a very insightful Heard on the Street column today in the Wall Street Journal.
Thank you very much. I think it's a good. I'll give you $5 after the show.
Okay.
Good promotion.
But exactly. I mean, yes, it is increasing the top line, but it's not translating to the bottom line, and that is going, in the long run, going to be a problem, and especially because this is a business that already you have Amazon and other larger companies already involved. And so when as Groupon tries to grow that business, and since they're starting at a low base, it's easy to get big percentage gains right now. At some point, it's going to go up against these bigger guys, and that's really where they're going to have a tougher time.
Yeah, this business is slowing overall. Living Social, who is still private, but publishes its numbers. Amazon, which made an investment, publishes numbers, and you saw that their third quarter, they were down. Travelzoo is another company that does deals. They're effectively number 3. They're public. They were down in the third quarter. And now Groupon was flat, but that was after including revenue from this new product. So you could say that, in a sense, they were also down. So, I mean, a lot of this business really comes down to Q4, I guess.
Right, and that for Groupon, the hope was they realized daily deals was never going to be a long-term business, or the prospects of that was remote, because it could be something that people grew tired of. So but the idea of them tapping into the local business market was what they were hoping to do, and using this as a way to get into local businesses. But making that transition from a daily deal site to something that does more for local business has been a rough one.
Okay, George Stahl, thanks for joining us.
Thank you.